Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is popular platform speaker and syndicated financial columnist, Ike Devji. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about specialty insurance that can differentiate you from the other advisors, all from Ike's articles and contributions to Optimal Financial Health, the doctor's essential wealth management and preservation handbook. Well, we know, after this whole week we've been talking about this, we're talking about specialty insurance specific to certain things. When I look at this, I'm thinking like, I know what umbrella insurance is for my personal. I know what my Arizona emissions is for my practice. Now we're talking about umbrella for my business. We're talking about, I'm on a board, I have a partner, I have employees, I have data breaches. What happens if my client's data gets out somewhere and my company was at fault, my employee? There are specialty insurances for all this?
Absolutely. And this is part of the layers that we started talking about and have sort of kept coming back to in all of our subsequent discussions, where we talked about the 3 layers in the asset protection pyramid. There is specialty insurance for this coverage, and we have seen advisors and clients blindsided by a lack of coverage or a lack of understanding of that coverage time and time again. So, for instance, I recently talked to a financial advisor that had a data breach exposure at his own practice. And in this case, the client's email, his AOL account, was hacked. And while the client and the advisor were genuinely going back and forth and discussing a transfer that the client wanted made and liquidation, and the client needed some money, and all of that was legit, the client and the advisor even spoke about it, all of the procedures were followed, and somewhere along the way, the bad guys slipped in after watching this whole chain, slipped in and took over the discussion on behalf of the advisor, or on behalf of the client, and acted as the client, adopted the client's name, tone of voice, language, font, email, everything, and was corresponding with the advisor as the client from the client's own email. They stepped in the middle of an ongoing discussion. The advisor went back to check when this exposure happened. It ended up being a 6-figure exposure that the advisor bared the liability for, even though it was the client who got hacked. And the advisor was horrified to discover that the multi-million-dollar E&O policy in place through his broker-dealer, in most cases that's forced-placed insurance, right? Your BD tells you, you will buy this.
Right.
The advisor was shocked to discover that it didn't include data breach coverage, and that if he had elected the data breach coverage as an option, it would have only been $50,000, which was less than the amount of the exposure itself. So, yes, there are specialty coverages that every advisor should be aware of in many forms for their clients and for themselves. Steve, we're in an environment where if you own a financial advisory firm, you have social security numbers, you have account numbers, you have detailed HIPAA information on your patients. You better believe you have an exposure, and if any of that's breached, it is on you. And it can happen 100 ways. It can happen through a virus. It can happen through hacking. It can happen through intentional misuse. We had a case here in Arizona with a medical practice where they had a drug addict working in the billing department of a very large and successful high-profile medical practice. Nobody was aware that this lady had a problem. She started using patient credit card numbers to make personal purchases, and the medical practice had to tell 40,000 people what happened. 40,000. Every patient in their database, and was financially responsible for any of the harm that incurred. Now, we could have protected that practice against that exposure for a $1,200 a year liability insurance policy if someone had told them.
Now, when you say $1,200, would that have been just for data breach issues?
That was, I believe, the cost of the data breach coverage.
So let's say the same business person who's going to pay $1,200 for data breach is also a director and an officer at in that company and or a charity.
Well,
that's an extra issue.
That is a separate issue as well. And again, there are 3 core kinds of coverage that most businesses operating in a modern American landscape should have. And this includes all of the advisors that are watching you today. So those 3 areas of coverage would be EPLI insurance, which is Employment Practices Liability Insurance. We also generally refer to it as employee lawsuit insurance. And that not only protects the business from a lawsuit by an employee, but it can help protect a business from a lawsuit based on the actions of an employee with a third party. So let's say you own a big company and one of your employees goes on the website and slanders another business or another individual on your company's website. Is that person going to sue you as the business owner, Steve, or the guy that works for you? They're going to sue you. Right? So that's an important issue. And this, again, also applies to all of the financial advisors watching your show today. We want to make sure that EPLI insurance is there to cover everything from a wrongful discharge to an employee liability claim. We want to make sure that everyone watching understands in the modern era where all money, it seems, moves electronically, and identity is one of your most valuable assets, that you better have data breach insurance in place to protect your business against either a third-party attack on the confidential information you hold, or against the intentional misuse. And then finally, we want D&O insurance that you referred to, which is directors and officers insurance, right? Because you have general liability insurance at your business that I refer to and help people conceptualize as slip and fall. I came here today to your beautiful studio. If I slipped and fell down and got hurt, you have insurance that covers that, right? You also have professional liability or E&O insurance for whatever it is you're doing. In between that is a big gap. All of the things that the business owner is responsible for, from accounting practices to employment policies to environmental issues, everything else, let's call it, somebody is responsible for at the end of the day, some executive officer or director. And that D&O insurance coverage can be in a business setting. It could be because you serve on the board of your religious institution, or you volunteered for your kid's school to be on the board, or you like the art museum down the street and you're on their board. All of those things carry liability, and affluent individuals should make sure that they are well covered. So for instance, if you own a business, you should have your own D&O. If you serve on someone else's board, they should have D&O that covers you.
Wow. For more information on how specialty insurance can differentiate your practice from other advisors, just click on the landing page address in the video description. We'll be right back with more with Ike Devji.
A solid web presence has never been more important to the success of your business. Introducing Agent Website Creator, provided by CreativeOne. Through Agent Website Creator, you can create your own personalized website and have it up and running easily with zero knowledge of programming. Choose from several designs with easy drag and drop customization. Get proven lead generation offers, professionally written articles, and helpful financial calculators. Plus, the ability to embed videos, integrate your social media, and more. Update your website anytime and show the world within minutes. The best part? It's hosted for free. To learn more about Agent Website Creator, call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're going to give you an update on the end of the year captive insurance companies and some of the ideas from his article and the contributions he's made to the Optimal Financial Health, the Doctor's Essential Wealth Management and Preservation Handbook. Well, I heard it. There's so much out on the web, I have to say, even in our area. All the places that I write, that you see me write, you write in some of the places I do, like Producers Web. People are talking about captives all the time. And I know that there are good people that are doing good work in captives and are highly skilled at it. And there's a lot of charlatans out there too. So end of the year, we're going to see some pressure coming here for the tax deduction alone. Ike, is the tax deduction alone a reason to look at captives as a risk management tool?
Well, I'm glad you started there, Steve. And the answer to your question is very simply no.
It's not enough.
It's not enough. And in fact, it is one of the red flags or badges of fraud that I think that the Internal Revenue Service would look for. A captive can be a great tool, and we've spent a number of segments together talking about the need for a variety of kinds of specialty liability insurance, in addition to your regular E&O or malpractice insurance and your general liability insurance and everything else that we've talked about. And we talked about three major kinds of insurance: data breach, employee lawsuit insurance, and D&O or directors and officers insurance. But that's just sort of the top three layers that apply to most businesses. There are many other kinds of very specialized insurance, from business interruption to terrorist insurance to earthquake insurance, right? Supply chain stuff that you can insure against all kinds of different things. Unfortunately, the captive is a good tool that is often abused, and it's abused both in the way that it is sold, which makes the IRS unhappy, and it's abused in the way in which it is understood and used by the clients themselves. And so we start with a couple basic questions. Number one, why is everybody trying to sell everyone else a captive all of a sudden? And there are a few different reasons, not the least of which is the fact that it produces a nice, significant referral fee for the person who brings it to the table. And that I am not one of these attorneys that thinks that everyone who gets paid makes an idea bad. That's absolutely not the case. But it can sometimes be a motivating factor for a good tool to be applied with a brush that's a little bit too broad, right? Let's go out and see who wants one of these. Let's see who bites, right? So it's a great tool, and it can absolutely do that, but you've got to have real risk and real claims and run it like a real company.
Well, let's say we really do have. I've met a lot of companies in my 30 years. They have real risk. They want to manage their claims. They don't want to pay any more. They feel like they can get in between the reinsurance treaty now and manage this themselves, which, remember, I'm not saying I believe that, but then a lot of people think that way. So let's say we have a legitimate need. And what are we doing? We're doing it maybe for taxes, but in the one I just gave, it's to save money on the actual insurance that I'm paying out for this.
That's absolutely correct. So that's one good reason to do a captive is to reduce the costs of your risk management. Meaning that, the way, and for those who maybe don't understand quite what a captive is when we set up a privately owned insurance company that meets all of the qualifications of any other insurance company, even a big one. So Dr. Bob down the street has a company that he sets up that has all of the compliance burdens of a giant like an Allstate, let's say, just to pull something randomly out of the air. So when we set that company up, as you said, it's important that they have real risk, and it's important that all of the right kinds of risks are covered in that, and that risk is reinsured in what you're talking about. Basically means that we used to buy the insurance retail on the market like everyone else. Now that we have our own insurance company, we can go out and buy it wholesale, and the difference between those two costs equals some retention of earnings, if you will, or a reduction in cost. It also allows us to buy more kinds of insurance, right, to get all of the specialty things that we might need for our business, and do so in a way that's more economically efficient. So, for instance, if we can go out and buy all of that for $50,000 a year for a big business, and we go out and set up a captive insurance company that now we are paying $1 million a year in premium to, you can see why that might raise a few eyebrows on the side of our friends at the IRS.
The last one would, before we leave our segment on this, is and you can't just sell captives because you're interested in selling a tax-deferred life insurance contract. I mean, there's a lot of games out here for that reason alone.
We do see the abuse of captives in the life insurance market as well, where people are trying to buy life insurance with pre-tax money, which we know is a no-no generally in most scenarios. And so, yes, life insurance, according to most of the experts out there that I work with who do the captive business every day, is not typically an appropriate asset to fund a captive with. And even inside the captive, when they talk about retained earnings and the profit to the owners, you have to remember that just because there's a spread between what the insurance cost us and what we used to pay for it, what it's worth on the market, that you still have to maintain significant cash reserves, and there are very significant limitations on what you can do with that profit that's generated inside the captive insurance company. And you have to have real risk. So one of my friends is a gentleman named Jay Adkison, who's considered one of the leading captive authorities in the country. And Jay uses the example of a guy in Kansas insuring himself against hurricanes as an abusive form of coverage that was in place just to bump up what the business owner could put into their own insurance company, even though they had no real risk in that area. So you've got to have real risk. There's got to be some economic efficiency. You've got to run it like a real company, and you can't fund it with everything you want, or everything that your advisor might want you to if you're the consumer. It's got to be done very carefully. Now, if we can meet all of those cross all those T's and dot all those I's, it's a great tool. And some of the biggest corporations in the United States have used captives for decades. And only in more recent times has it become something that's trickled down to consumers. But I'll tell you, Steve, as much as I like the tool and believe in it, I tell 9 out of 10 people who ask me about it that they have no business having one, because the numbers and the risk and all of the other things we want to see just aren't there. So this is a really good way to close out a series of conversations about liability insurance and risk management, which we've been having, because at the end of the year, as you said, we know that business owners and physicians scramble under high sales pressure to get some kind of a new tax plan in place. So the caveat that you provided to your viewers at the very opening of this segment is important, that if you are seeing this marketed to you as a tax savings mechanism primarily, and if the website and the materials and the fancy brochures that you're getting talk about tax more than they talk about risk, run. Because when the IRS sees that, they're going to want to come have a talk with you.
Well, listen, for more information on captive insurance companies, just click on the landing page address in the video description. And for more information on all our shows, seminars, and workshops, just follow us out on social media or visit us out on our webpage. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.